TAOS Chapter 1. The Art of Sprezzatura. Investing. Have a plan. Do the mathematics. Wait, stay unemotional. The book before you contains lessons from my 15 years as an analyst, portfolio manager, and principal at the hedge fund Hubris, a fund that in 2010 was given the HFR European Hedge Fund of the Decade, all categories award, for the years 2000 to 2009. Before that, I learned the financial ropes in 1994 to 2000 as a top-ranked sell-side equity analyst, but nothing can teach you investing as carrying the actual risk at a hedge fund can. In 2015, I released an ebook about my time as a hedge fund manager. In it, I derived and detailed around 50 investment lessons from my and my colleagues' mistakes, failures, and successes that we achieved during my 15 years at Hubris. In the book you have before you, TAOS, I have condensed those 50 guidelines into 12 desirable investor traits. Investing is a game of psychology, not numbers. Despite being more of a numbers person, my overarching investment message has always been that the psychology of investing is much more important than the numbers. You still have to do the maths, though, using actual facts, not opinions. And you have to diligently assess the competitiveness and endurance of the companies you are researching, or other fundamentals that are relevant to your style of trading or investing. Most of all, however, you need to keep yourself in check. Stay calm whenever facing a pressing decision. Discard good deals and wait for great ones. Don't let others rush or deter you. Investing is absolute, not relative. Avoid trading on emotion and use checklists to counter psychological biases. Ray Dalio states, "More than anything else, what differentiates people who live up to their potential from those who don't is a willingness to look at themselves and others objectively. Human nature did not evolve with investing in mind, and thus is potentially a source of great misfortune as well as opportunity. But if you master your own psychology and manage to avoid a few very human mistakes, you will find yourself leagues ahead of most market participants. It's easy on paper, but can be hard in practice. That's why I have collected my investment lessons in this book. It's written as much for myself as it is for sharing my ideas. Those guidelines are what I call TAOS, the Art of Sprezzatura, how to make hard investment decisions seem easy. The Art of Sprezzatura. I'll begin with a summary of 12 desired investor traits, grouped together in 4 themes, where several traits often fit in the intersection between 2 different themes before delving deeper into each trait. The 4 pillars of TAOS are being patient, analytical, unemotional, and strategic. Patient. Wait for the right opportunity in accordance with your strategic plan and its underlying mathematical and statistical foundation. A solid strategy that you trust makes it easier to be patient and remain calm and methodical during losing streaks. Analytical. Do the maths yourself. Track your decisions and outcomes. Adapt and improve your models and strategy with new information from outside your echo chamber. Unemotional. Avoid herding behavior, hubris, greed, and fear. Feelings are evolutionarily mismatched with investing. Hope is not a strategy. Neither is copying others. Stick to the plan and never succumb to sudden emotional whims. Strategic. Have a plan. Any plan is better than no plan, as long as it's subject to evaluation and evolution. Make sure it has a logical underpinning as well as is a good fit with your particular temperament. Then backtest your plan against historical data. Record your investment decisions and outcomes and regularly adjust your strategy accordingly. With enough time and practice, your strategy should become a robust and trustworthy tool. that can assist your constant battle against emotions and impatience. My pillars aren't yours. Below follows a brief summary of how I have calibrated the 4 pillars to my specific psychological and mental disposition. Your version might very well look quite different while still being at least as effective at producing the wealth you are targeting. My strategy: I prefer a value-oriented style, grounded in the microeconomic business logic of single enterprises and supported by a macro backdrop of longer economic and stock market trends and cycles. Further, I don't like single large bets or frequent trading, instead focusing on long-term investments with a broad geographical, industry, and asset class diversification. My patience practice. Patience, both in and out of markets. I myself am patient to a fault, not seldom venturing into the swamp of denial, SOD. My mathematics: keep track of your decisions and trades, your entry and exit points, your logical thinking, as well as your feelings before and after those decisions. The aim is to make sure you learn something from every loss, from every gain, making you a stronger investor with every trade, no matter the result. That is the meaning of resilience. I, for one, could definitely do better in this area, as I occasionally exhibit unbecoming streaks of ad hoc thinking, laziness, complacency, and hubris. Howard Marks says, "The screwiest thing you can do is think you're a master of the universe. We're all just little cogs, and the universe will go on without us. We have to fit into it and adapt to it. Not least, make sure the deal really is as good as you first think, rather than relying on your own track record and assumed superiority. Talk to people who harbor contrarian opinions and complementary knowledge, and triangulate valuations and market positions from several different vantage points." My emotions. It's easy to advise against going all in, but harder in practice. Sometimes certain opportunities just seem so good, greed gets the better of you. It might help considering that if an investment is that great, you don't have to put very much at stake to make a killing. The 5th element: self-analysis. Money is just a gauge of your progress towards self-actualization and freedom. Investing is a lot more than just money. There's a 5th pillar. Actually, it's more of a roof, linking and strengthening the 4 pillars. Self-analysis, feedback, and adaptation form the basis for continuous growth. Strive for a growth mindset, always learning, always improving. Analyze your hits as well as your misses in order to identify which traits were in play, which traits can be improved, and how. Remember the following: investing means building, growing, learning, and acquiring tools for continuous learning, perspective, and improvement. The most important thing in investing is having a strategy to begin with. So let's start there. Sticking to your strategy is much harder than formulating it. Investing isn't easy. Investing involves considering a multitude of different kinds of investors: consumers, companies, managers, employees, fiscal and monetary policies, weather, disasters, your own psychological biases, and not least chance. Investing thus is like playing a multi-dimensional board game that makes Go seem like child's play. You can choose a more or less complicated strategy, but if you don't stick to your own rules, you'll be completely lost at sea when losses strike. Strategy. Having a strategy means having a system for making investment decisions that you apply consistently and rigorously comply with. The antithesis is an ad hoc approach, relying on intuition and gut feeling. Some prefer a fundamental, value-based stock-picking strategy. A system like that can be a pretty good insurance against permanent losses if market momentum suddenly turns negative, since you can afford to wait out the weakness. Others prefer value-agnostic methods based on, e.g., momentum or specific share price patterns. In theory, technical analysis-based trading can make money in any market environment, but you have to be quick on your feet and use robust stop-loss strategies to succeed long-term. Yet others rely on broad asset class diversification strategies, e.g. with fixed rules for periodically adjusting the relative asset class weights. Some investors focus on analyzing macroeconomic information, while some prefer pair trading, focus on special situations, or risk arbitrage. A select few have successfully chosen more or less complicated derivatives strategies. The point is that there is no one optimal investing strategy. You can get rich or poor fast with any of the mentioned strategies. Many different strategies can carry the required load on the financial markets equally well, and different strategies work better for different individuals or institutions. It's consistent execution of the chosen strategy that leads to exceptional results. Hence, you should choose a strategy, logical, rational, and back-tested, and modus operandi that you are comfortable trusting in good times and bad, neither amending your sizing, risk tolerance, asset allocation, or positioning during streaks of good luck, nor in streaks of bad luck. However, do adjust the strategy deliberately if needed, but don't deviate from it in ad hoc fashion based on emotional reactions to particular circumstances or stress. My personal diversified barbell quattro strategy. My own strategy is based on thorough fundamental research on individual companies. I want to buy fair companies at a fantastic, low price, including unproven startups with great ideas at very low market capitalizations. I tend to find it difficult buying so-called great companies at great prices, mostly since I find it difficult to identify outstanding companies without their prices being insane, a price point I've never been able to stomach. I typically buy a position in increments over a fairly long period of time, sometimes weeks, sometimes years, mostly to avoid the psychological blow of buying or selling the entire position at the wrong price right before an unknowable event. I do this partly to enable buying on sudden price drops, and partly in order to learn more about the company before becoming psychologically stuck. In addition, I trade around long-term positions whenever the share price overreacts due to news or movements in the general market. I'm always prepared to lose money, albeit not Bond pit trader style like Mark Spitznagel, but rather as part of reality's natural tendency toward an unpredictable range of outcomes. To ensure against too large losses, I have diversified my holdings across a range of assets, including my mortgage-free apartment, physical gold and platinum assets, private companies in a range of industries and stages, private bonds, loans, and a few listed stocks in various sectors. While most of my investments are relatively safe and low volatility assets, I do have a significant exposure to startups and other private equity that could explode in value. Hence, even if I don't ever risk getting poor by putting too much of my wealth in risky assets, I still have a large upside. I combine my bottom-up investment style with a top-down view of the general economy, as well as an overall view of the stock market, in particular, the revenue valuation level and trend convergence of technical gauges, in order to decide on my overall risk level and how to weight the various slices of my investment pizza. A quattro stagione with some real estate, some gold, some loans, some private equity, and some listed stocks. In short, my strategy can be summarized like this: bullet, fundamental, bottom-up, value-based stock picking. Averaging in and out of positions. Position trading, selling on surges and buying on dips. Overall market valuation. Overall market trend. Top-down macroeconomic overlay. Asset class diversification. A barbell symmetry with mostly safe holdings and some exhibiting high risk and high potential features. Patience. Patience is paramount for reliable investment performance. Investing is easy. At least some say investing is a piece of cake. You just buy and hold, and then you retire rich. Unfortunately, it's actually not quite that easy. At least not for mere humans, mainly since we tend to lack the required patience. Never rush your decisions. Chasing an investment means you're already too late. Sometimes you have to wait a very long time for your returns. In just the 8 years between 2009 and 2017, the S&P 500 index surged from 666 to almost 2,400. The annual total return of some 17%, including dividends of approximately 2% per annum, turned $1 into $4. On the other hand, if you bought at the peak in March 2000, you would still have been down by about half 9 years later and just about breaking even after a full 13 years. Over the 17-year period, 2000 to 2017, your annual return before dividends would have been just 2.5%, albeit compounding into a not too shabby 50% total return, and approximately 4.5% per year, including dividends. I'm tempted to include that the non-financials market cap, gross value. Added multiple for the median company in the S&P 500 index is the highest it has ever been. Were it to revert to its mean within a year or two, you would still be down on your investment in S&P 500 from almost 20 years earlier. Were it to undershoot, as it has done many times before when financial bubbles have unraveled, an even quarter century is probably the eventual tally of years for getting exactly nowhere. The positive news is that after that, you could look forward to a more normal 5 to 10% annual returns on average. Fortunately, there is another way to harness patience for outperformance. Instead of investing blindly and waiting for decades upon decades for a half-decent return, you could start with the waiting. Bide your time and wait until. The target manifests your desired margin of safety, putting patience first. Whether investigating an index position through an ETF for an industry, an entire market, or for an individual stock, don't rush after the impatient fools. The inexperienced and impatient investor is more easily led astray by the herding instinct and social proof bias. In addition, he tends to think, or feel rather, this is the last opportunity to get on the train. His fear of missing out, FOMO, leads to rushed decisions. When everybody else seems to scramble to invest every last dollar and then some borrowed, it's easy to get the impression this really is the last chance. That, however, would imply future generations will be left out altogether, a wholly implausible postulate in an industry that is known for its oversized long-term fluctuations. The impatient tend to buy high in manias and sell low during panics and crashes. Instead, wait for a good opportunity. No, scratch that. Skip the good ones and wait for a great opportunity. Keep your powder dry while accumulating useful knowledge and turning data into information and reliable investment decision support. When the time is right, you pounce. You don't have to write monthly reports to investors, just a life report to yourself. Use that advantage. When others are selling in panic at bargain basement prices, when margin calls make bubbles revert to the mean or invert to even lower levels, you make good use of your patient cash. Buying at low valuations gives you a larger margin of error for losses and a larger expected return, given a specific future outcome, albeit unknown. Wait, study, wait, pounce. Patience means being able to withstand the herding instinct when the fundamentals are wrong, but fools are buying left, right, and center. It means having the psychological pain tolerance to wait for a good entry point as well as a good exit opportunity. It means trusting your own system enough to actually invest according to the ex-ante chosen strategic time horizon, not just paying lip service to it. There is no one optimal investing strategy, but you need patience to reap the rewards from the one you've chosen. Without patience, you effectively jump from trade to trade without an overarching strategy, which is tantamount to not having one at all. If you feel an urge to make a trade before having enough time to understand it properly, turn to a less urgent investment instead. If time runs out on one investment, simply turn the hourglass and investigate another. As a value investor, I'm used to waiting, sometimes when buying a cheap company in the middle of a bursting bubble, sometimes when holding off buying when other investors are chasing story stocks. Buy and hold strategies also entail a lot of waiting, but rather after a purchase than before. Resilience, the ability to rise from the ashes. Investing inevitably brings losses at one point or another. As long as you are ready and have a plan for dealing with them, losses are but an opportunity to learn and grow as an investor. Some go as far as saying you have to love losses and take every opportunity to take a loss. The faster and smaller, the better. Don't panic. The investor Mark Spitznagel details in his book The Tao of Capital how tactic, serial one-point losses in the bond pit were but steps along the way of a strategy leading predictably to recurring 5-point, 10-point, or higher order profits. The bigger the targeted profit, the more numerous the expected losses to get there. Spitznagel had a strategy, he had patience, and he had resilience. In value investing, as opposed to pure trading, the underlying strategy of paying less for assets than the cash flow they can expect to produce means time works in your favor. Any loss on paper would only be temporary, and actually an opportunity to increase your holding given your initial analysis were correct. However, whether you're adhering to a trend following or a similar technical analysis-based strategy, or fundamental value-based investing, knowing when to take a loss and de facto executing the order is critical. No matter the source of your losses, be it bad luck, poor execution, or subpar analysis, the losses per se are not that important, unless they are total. It's the post-mortem actions you take and what you can learn from them that count. Resilience means gaining from adversity. It means being anti-fragile, learning from losses and coming back more knowledgeable and thus a stronger and better investor, owing to the loss, not despite it. It means understanding losses are a part of life for every investor. It means preparing for those losses. It means knowing beforehand how to deal with losses when they inevitably occur. It means understanding your thinking can change radically when going from an ordinary situation to one of losses and a sense of urgency, and how to prepare for that cognitive shift. It means taking advantage of panics, not succumbing to them, going from denial to enlightenment. Kubler-Ross's model for the psychological reactions to adversity lists denial, anger, bargaining, depression, and acceptance. As an investor, you should strive to get through to acceptance as quickly as possible, preferably skipping all the other stages altogether. And B, it's not considered possible to skip stages in the process, so I advise setting up a system for immediately countering loss denial through unbiased analysis and dealing with anger, bargaining, and depression swiftly by, e.g., imagining yourself a few years into the future, looking back at the situation at hand. Deal with one issue at a time. Breaking down problems into their atomic constituents often makes solutions seem clear and self-evident. Identify exactly what is wrong, with which particular positions, or whether it's a global portfolio problem. Then proceed systematically and deliberately, with one issue at a time. Trying to deal with all problems at the same time will get nothing done, while full attention to one at a time
will eventually get everything done.
If your survival hinges on being right on a particular position, then that position is wrong for you. Often, divesting the entire position is the best you can do, certainly for trading positions, but also if you've lost control and faith in a value-based investment. If you don't know why you hold it, sell it. Sure, it will cost you the spread and commission if you decide to re-establish it later. It may also prove to be a poorly timed decision. However, in any case, not having the position anymore means a guarantee of no more losses and room to think rationally about what the next step should be. Remember, if your survival hinges on being right on a particular position, then that position is wrong for you. Avoid exacerbating your previous errors by committing a new one, such as sticking to an indefensible position. Remember to inspect the ashes
thoroughly
before rising again. After dealing with a loss, update your investment commonplace right next to your notes of why you initiated the position with what made you keep the position, why you incurred losses, e.g. bad luck, changed fundamentals, reluctance to take a smaller loss, deviance from your strategy, etc. Why you didn't get out sooner, what you plausibly could or should have done differently, and not least, what the actual lesson learned was. If warranted, update your entire investment strategy with the wisdom gained from the loss-making experience. Ultimately, you want every loss to make you a better investor, always calm, composed, and rational in the face of calamity. Build resilience by preparing, analyzing, and learning from your losses, a game of psychology.
Investing is mostly not about being the best mathematician or statistician, not about making the best macro or micro forecasts, not about being the best earnings announcements trader or arbitraging from special situations. Rather, investing is mostly about managing your own psychological reactions and gauging and profiting from others' unwarranted emotions.
If and when you are struck by losses, you need to avoid panicking, need to accept the losses as quickly as possible in order to stop the hemorrhaging and start looking for remedies, perhaps even turning the current bloodshed into an opportunity. Most of all, you want to use the lessons learned through adversity to build an even more robust investment system for the future. Therefore, you should learn to love losses and let them make you resilient. Endurance, making sure you're there for the next round. Never go all in on an investment. No matter how good a trade looks, you should always prepare for being wrong. Since there are no absolute truths or absolute certain sequence of events, you can never know enough, even theoretically, for betting everything. Hence, you should always be open to surprising outcomes. More things can happen than actually do happen. The most likely event of a twin coin toss is 7, but the most frequent outcome is not a 7. Fostering endurance means minding your surroundings. The risk of black swans, unlikely events with large consequences, and sudden, unwarranted price movements. Even if you are right, the market can be wrong for a very long time. Thus, make sure you keep reserves good as gold for the next round. There is no such thing as a complete certainty in the real world. I am not uncertain. Bobby Axelrod, dollar bill. Before optimizing, eliminate elimination risk. To be clear, endurance does not concern portfolio optimization or profit maximization.
Endurance is purely about survival, about protecting the ultimate downside, about never being wiped out completely, whether struck by a 1930s like collapse, the Nifty 50 surge, the 4,000% gold spike in the 1970s, or its subsequent collapse, the 1987 Black Monday event, or the IT and house bubbles and their bursting, not to mention the crypto mania of today.
Endurance, in its purest form, literally means making sure you are still, in poker parlance, around to play the next hand. And the one after that. If you play your cards sensibly, and most importantly, never go all in, total time in the market works in your favor. Endurance means investing in a way you never risk all, and thus never lose all. Endurance means fully internalizing the inherent uncertainty of the future, thus understanding you can never know enough for an all-in position. People lie, earthquakes quake, tsunamis hit, politicians change their mind, other people lose their nerve. If you lose all on an absolute certainty that turns out to be wrong, there is no way back. It is your responsibility at all times to avoid a total loss. If you actually want to predictably move forward rather than just gamble for kicks. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Mark Twain. If you lose all, no strategy, patience, resilience, or learning system will help you recover. I often say patience is the most important thing in investing. But if there's nothing left, patience won't help you. Neither trying to wait out a bet gone wrong, nor being patient to a fault and waiting for the perfect investment opportunity with a 99% probability of success will do you any good if you still lose all. A tip for endurance while capturing a major part of the upside is using Dr. Ed Thorp's Kelly criterion. It links estimated return probabilities and warranted position sizes. Thorpe himself advocates using Kelly/2 for ordinarily risk-averse individuals. It should provide some 75% of the upside, while significantly reducing the amplitude of drawdowns. Personally, I find the KC difficult to use in practice due to having to estimate probabilities in the real world. Shit happens. Make sure it doesn't affect your entire portfolio at once. The benefit of premortems in high-stakes situations. If you're facing a potentially high payoff, but with a risk of total loss, and you're thinking in terms of putting all eggs in the best basket, which a friend of mine actually did in the dot-com bubble, think again. Whenever feeling cocky or referring to real men, make it a reflex to back off and perform an objective pre-mortem analysis of your situation. Pretend the worst has already happened, i.e., do the opposite of dreaming of hitting the jackpot, of showering in gold coins, of being revered as a player and BSD. Imagine instead you're standing there after the fact, laden with debt and without a cent to your name. Ask yourself what went wrong and what you could have done about it if you got a do-over. Risks of unacceptable losses are unacceptable. Zeal means going the extra mile to kill your darlings. Approaching the summer of 2013, in my capacity as portfolio manager at a hedge fund, I had a significant short position in the banking sector. During a sudden Eurozone market panic, which for us triggered the divestment of several long positions, I increased my already profitable bank shorts. It seemed like a home run. I had already done the necessary micro and macro research when establishing the position. Now that my scenario was coming to fruition and the position was paying off, I saw the potential to increase it significantly in order to take advantage of a likely cascade of events involving defaulting South European banks with large exposures to government debt. Not long after, the market bottomed as central banks rode to the rescue. Not least, banks' shares turned sharply upward. Every day, for the ensuing 6 months, I came up with some kind of new argument for holding on to my shorts for a while longer. Fear of regret, confirmation bias, moralizing, etc. Meanwhile, the initial quite handsome profit first shrank to nothing and eventually inverted into a big loss, which exacerbated my psychological biases and homeostasis. Instead of truly questioning my previous research and conclusions regarding European banks, given the new information of globally synchronized central bank accommodation, I stuck to my view of ever-increasing European turmoil. I was both psychologically and mentally too weak to wipe the slate clean, change my vantage point, and try to see what the buyers were thinking and doing. An important lesson from the experience is that stupid market reactions are very rare. The market is what it is and does what it does, and the connection with real events can't be considered right or wrong in the typical sense. As a market participant, it's only you who can be stupid or intelligent in your investigation of and reaction to market events. It's you who need to explain in what way a surprising move is right and what it reflects in terms of, e.g., positioning, surprise, conclusions, etc. Proactively and diligently look for weak points in your own research, arguments, timing, and investment decisions. Too complacent to understand the other side. I was both too lazy and too proud at the same time. Indulgent, really. Too proud to admit my error and start over. Too lazy to rethink my scenario taking new information into account, such as investor optimism and central bank resolve. Not to mention the fact that rising bank stocks de facto make banks more solvent through cross-ownerships and by enabling share issues. If I hadn't lacked the required zeal, I should have gone back to the drawing board and redesigned my entire scenario for monetary policies, the solvency of banks, as well as the market's appetite for bank stocks in that event. I should have made more of an effort to understand in what way central bankers and other investors were right, and in what way I was wrong. Instead, I clung to conclusions I had drawn under different circumstances and to moralizing arguments about why it was wrong to promote moral hazard and wrong to buy banks that profited from it while increasing long-term systemic risks, risks that were too far off to have any impact on my decisions at the time. Challenge the premises of your investment opportunities and constantly look for threats to your current convictions. The devil is in the details. Applying zeal means internalizing the fact that the market devil often resides in the minute details. Sometimes it's a question of going over every footnote in the available financial reports, checking for error, signs of fraud, or symptoms of hidden disease and danger. Sometimes it's a question of understanding other investors, their preferences and behavior. Sometimes the detail is of a more holistic character, e.g., how your investment stacks up relative to other investments rather than its absolute merits. Identify and understand the strengths of the antithesis. No matter what the issue is or what the specific answer or solution might be, what I mean by investment zeal is not being content with having established a specific investment case. Rather, it means that your well-researched absolute value investment case is just the beginning. Zeal means looking for holes and omissions, trying to understand what the sellers are thinking, wanting to find out you're wrong. Just as Spitznagel learned to love losses, a diligent value investor needs to love finding flaws in his reasoning. The sooner, the better. Actively strive to disprove your own ideas and understand and prove your opponents. Some time ago, I privately lost 70% in a single day on an investment in a small Swedish biotech company, Peptonic. That loss was entirely due to my lack of zeal. I had originally bought some shares in the IPO. The shares increased some 50 to 60% before crashing by 80% from there to about a third of the IPO price. I then increased my position sixfold, close to the share's low point, in a move that was as gutsy as it was lucky. The share price subsequently doubled for no tangible reason, and I divested about half of my position on a whim. Why not take profits on 100%? That instinct turned out to be my saving grace. However, I kept the other half of my position over the catastrophic clinical study result. All in all, I did little better than break even on this train wreck, thanks to trading around the position. What I did wrong was buying based on liking the underlying science and the people involved, rather than diligently checking the merits of the case, not to mention questioning my own reasons for buying and holding. Sure, I knew the risk of failure was high. I mean, the company had already failed once. In addition, biotech companies fail all the time. What saved me was dumb luck due to guts and sizing. Quite the opposite from diligent research and measured position taking. I took a very small position in the IPO and a significantly large one after the first crash. My saving grace was divesting half of my enlarged position when the stock exhibited absurd surges. The stock's strong performance was inherently without merit, especially considering the risks of investing in a single product biotech company that had already manifested serious quality issues.
You do the mathematics.
I knew all this, but still didn't care to do the actual mathematics. I even convinced myself there was no mathematics to be made, which in itself should have been enough to not invest from the beginning. Get out after the first surge. Get out after the first crash. Definitely get out completely after doubling my money, actually earlier, on the six-fold position, which I never should have taken to begin with, given my lack of zeal, instead of just selling half. You're never done.
You do the math is a rhetorical quip, meaning just add 2 and 2 together and you'll see what I mean.
It also means you should actually do it yourself and not just trust somebody else to do it for you. All too often, the mathematics never gets made at all, since everybody is counting on others having already done the required calculations. Not only should you do the adding, the mathematics, but check the sources for the 2's as well. Getting to 4 still doesn't mean you're done. You're never done. That's the meaning of zeal. You need to ask yourself and others what 4 actually means, both from an absolute perspective and from as many different relative vantage points as possible.
Don't be afraid of errors or of being proven wrong by yourself or somebody else. Finding errors shouldn't be embarrassing. Not finding them should be. You should want to find out you're wrong. The sooner the better. If you're lucky, it'll be before the market does.
Avoid my mistake above and check and recheck the premises of your investments. Do they hold up to external scrutiny, or are they mostly based on chance and complacency? Finding flaws in your reasoning should be a source for joy.
Zen, a Zen mind of perspective and calm. Confront unexpected events with equanimity. Few events are unequivocally good or bad, and opportunities will cycle back. Reflect and take mindful action rather than react blindly.
Strive to create habits and design environments that lend themselves to calmness and perspective. Maintaining a Zen mind combined with enabling surroundings frees your rational mind of the shackles of panic. There is no room for panic in a rational investor's mind.
Boom! A profit warning, a collapsing Ponzi scheme, extreme weather, fraud, a takeover, if you're short. Suddenly, you find your portfolio suffering from toxic assets and riddled with loss. How about a margin call on top to get the heart pumping and your head spinning? When reality rears its ugly head of randomness and unpredictability, it's all too easy to let panic take over. Even without actual losses, a soaring stock price in a popular company or asset class can create a sensation of urgency, of missing out.
The questions attack you with a fervor rivaling the market's assault on your portfolio. Should I cover? Should I stop my losses? What if I do? What if I don't? What's the best course of action? Is there risk of reputational damage, of losing clients, of regret? What would I do if nobody saw or second-guessed my actions after the fact? Getting out now would hurt financially, but if it turns back up afterward, might hurt even more psychologically. Can I afford to lose more? What measure would be contrarian? What would be going with the herd? Which would be best in this case? What measure would look smart Is the train about to leave the station and I will never get the same chance again? It's easy to feel like there are only bad solutions and outcomes of financial and reputational losses and remorse, and no time to make a rational evaluation. As the panic feeds on itself, making it increasingly difficult to think rationally, self-doubt creeps in. In that situation, you are extremely vulnerable as an investor. You can't think straight. You don't trust yourself. Like Schrödinger's cat, you're simultaneously as prone to taking drastic action as you are to sticking your head in the sand. Often, you are susceptible to external influence by potentially false authorities, since you've already dismissed your own competency, ready to act on the vaguest of rumors or dubious of recommendations. You are being irrational. Stop that.
First and foremost, if you have followed my advice on resilience and endurance, there is no need for panic. You're prepared emotionally, and your positions can't melt down to zero. In addition, you should have a strategy in place dictating the correct steps and measures. Panicking would only serve as an irrational reaction to a sudden loss without any reason for major concern. You might experience a feeling of urgency, but in reality, there isn't one.
Second, even if you're actually in real trouble due to failing to heed the advice in this book, panicking won't help. Quite the contrary. Calm down. The first thing you need to do is calm down. Stop flitting from one chart to the other. Instead, consult your best practices notes or your strategy document. Don't make any rash decisions when highly emotional and under the control of your amygdala. The fight or flight reaction to high stress on the financial markets is an evolutionary mismatch which needs to be mitigated. Human psychology, economics, and financial markets move in cycles. Internalize that concept for use. During times of turbulence, Zen means putting things in their right perspective. Zen means not overreacting. Zen means controlling your emotions. Zen means understanding the cyclicality of nature, of humans, and ultimately of financial markets. Zen means integrating the knowledge that missing out on a soaring stock doesn't mean you'll never find such an opportunity again. Zen means understanding that you're not part of the last generation to ever get to make money investing in stocks or real estate ever again.
Meditate and study your emotions
to be ready for coming challenges. Zen state of mind for investors. Zen means keeping calm, having practiced methods for keeping unnecessary emotions at bay. Zen means fostering habits of exercising, walking, meditating, and metacognition. Zen means knowing yourself well enough to refrain from making decisions in an agitated state of mind, as well as keeping a set of tools for allowing your rational self to take over when needed. It's never as bad or as final as you think. Keep calm and you will eventually find a solution. Reminding yourself that you know enough, that you possess the required knowledge, helps regaining your mental balance. Knowing that you have a functional strategy is another valuable mental anchor. Remember that opportunities will cycle back, and that a loss is but a step along the way to mastery, as long as you avoid complete disasters. There will always be new opportunities, and you will always be able to bounce back as long as you don't wipe out completely. Just as there is never a hurry to get rich, never a risk of non-exposure, there is also never a rush to take drastic action during stress. Control your emotions, lest they control you. Zen is not about weird mantras or silly riddles. Zen is about nurturing a set of habits and an environment intended to help you keep the right perspective in turbulent times, thus allowing your knowledge, skills, strategy, and rational mind make the most out of any given situation. Zen means having a growth mindset, embracing losses as lessons, and facing both sudden plunges and surges with the same equanimity and willingness to learn. The opposite to Zen is framing downturns as permanent failures and panicking over lost opportunities. Increasing the risk level to remedy losses is not the way. Reducing the mental effort and looking for shortcuts is not the way. Lashing out is not the way. Fall back to the level of your training. Break down any issue into its components and deal with one problem at a time, calmly, rationally, and with equanimity, with a Zen mind. Don't panic. Agility. Agility of mind is a required skill in the dynamic and complex ecosystem of investing.
It's complicated.
The master of risk, the great Howard Marks of Memos from the Chairman and Oaktree Capital fame, not to mention his must-read book, The Most Important Thing, once clarified, "I didn't write a book about investing methods or try to convey an easy way of investing. I deliberately wrote a book about mindsets and psychology." Marx went on to explain how investing isn't easy at all. Quite the opposite. As Marx say, reasoning about financial markets and investments has a way of turning back on itself. Valuation, momentum, popularity, money on the sidelines, volume, trend uniformity, etc. all have a recursive element to them. If I know this, maybe everybody does. If this is cheap or the trend is negative, perhaps it's for a reason. Money on the sidelines might be because of poor prospects for risk assets. Or does it mean latent buying power? Is popularity good or bad for a stock? It's complicated is a catchphrase for most mature relationships. Well, it's complex is its financial equivalent. Complicated means something contains a lot of details, like an expensive mechanical Swiss watch. No matter how many moving parts, however, a complicated system is still deterministic. Complex means a system of moving, interdependent parts in hard-to-define relationships to each other. Newton's three-body problem isn't very complicated, just three parts, but it's so complex there is no solution. The market is a complex soup of mathematics, statistics, psychology, politics, randomness, and game theory, to mention but a few ingredients. There is no final solution, no final model to follow, no forecasts worthy the name. Agility, survival of the most adaptable. So what can you do faced with the complexity of financial markets? You can be agile, you can be curious, you can be a learning machine, you can engage with and understand your adversaries, never being content you know enough, never resting on your laurels. You can explore several different ways of calculating the same thing. You can triangulate between several different valuations methods and several different multiples within each method. You can map owners, directors, suppliers, competitors from several different aspects. You can investigate absolutes as well as relative valuation, momentum, competitive positioning, political risk, customer satisfaction, possible substitutes, technological development, etc. Don't believe everything you think. There really is no end to the work you can put in when researching an investment. And yet, there is no definitive answer at the end of your efforts, no matter how Herculean. You can still be wrong, since investing in risky assets means there are several potential futures of which you will only find yourself in one. If it's a less likely one you didn't want, you'll have to be agile enough to adapt your calculations and decisions according to the new circumstances. Valuation and investing is about a never-ending dynamic triangulation of fundamentals, trends, and other people's sentiment and knowledge. Actively seek new and seemingly impossible angles regarding all three. Be aware of vantage points different from your own. Agility means seeing market complexity for what it is, including the following. Macro forecasts are mostly useless. Whatever forecasts are possible are useless anyway, since they tend to get discounted. You can never be certain, see forecasts, but you can line up probabilities in your favor. there is no one definitive answer, but you can keep several potential candidates and contingency plans for each in mind. Recursivity, interdependence, group psychology, and randomness mean no situation is the same. A fact made all too clear to me in the most recent long bull market that began in 2009. I erroneously thought all the facts I needed for a rerun of some of the worst downturns in history were in place. Had this been my first bull, maybe I would have been less complacent and more open to the merits of, e.g., concerted money printing, not to mention the resolve, madness of central bankers. Agility means being open to alternative explanations and scenarios without succumbing to the 50-50 fallacy of two scenarios always being equally probable. Equity, research, and value investing is as complex and frustrating as Escher's art and impossible figures. Temperateness. Temperateness, avoiding hubris and not believing your own hype. There's a difference between celebration and hubris. I cringed when I heard the opening line one morning in one of Sweden's largest podcasts, Framgångspodden, Best of 2016 Part 2, episode number 105. Mikael Syding, one of the greatest investors of all time. It's a good thing I don't believe my own hype. If I did, I would be reckless, thinking whatever the hedge fund manager of the decade does must be the right course of action. The reason people like Buffett, Dalio, and Soros keep outperforming decade after decade is that they take the task seriously. They exert themselves, they make sure they do all they can rather than relying on past successes. To be perfectly honest, I don't understand how they do it. I myself have more or less regularly exhibited hubristic streaks several times over my investment career. My first and possibly worst such mistake was recommending a VR/AR company, Prosolvia, back in 1997 to 1998. It went bust not long after in the worst bankruptcy for a publicly listed company in Sweden in a long time. I had fooled myself with, half-assed it turned out, channel checks, calling or emailing reference clients, part owned by Prosolvia, and most likely complicit in the shady accounting practices that inflated reported sales and profits in order to verify the company's exponential growth and profits. And when the warning signs appeared, I ignored them, constantly looking for facts and arguments supporting my view of the company, defending my position instead of questioning it. I didn't do it consciously, but I thought that since I was the one recommending the company and I was the one analyzing it, I was also the only one truly understanding its potential. Big wins are always part luck, and big losses stem from overconfidence and loss of prudence. It turned out I was in fact delusional, thinking things like, I'm top ranked, I was the IPO moderator, I've made several successful recommendations over the last few years. At that point, I was a typical self-proclaimed genius that really was just the product of a strong bull market tide, lifting all boats. As I detail in 50 Lessons I Keep Forgetting, there was a regularity to my periods of hubris and recklessness. A methodical daily grind tended to produce good results. The habit of working hard, combined with stronger confidence and some luck, often led to great results. Great results begot complacency, while earlier investment decisions, luck, and trends kept producing gains, eventually fostering a God complex, a feeling that I couldn't do anything wrong, that I was somehow suddenly superior. Hubris led to not only less thoroughness, it also made me increase the risk level, not least if an investment went against me. Sooner or later, laziness, complacency, and increasing risk caused losses, denial, anger, bargaining, depression, and eventually acceptance, so the cycle could start all over again with diligent grit and tight stop losses. Temperateness. Just like bull markets, booms, manias, and bubbles typically have sound beginnings. So does hubris. Hard, diligent work isn't only occasionally rewarded with success. Exceptional results also tend to gradually boost your confidence, sometimes to the point of delusions of grandeur. Don't allow yourself to become complacent after a lucky streak. You are, of course, partly right to be confident your skill is real, right to be happy, and enjoy your attained intellectual standard and investment prowess. But you are terribly wrong in thinking you can stop fighting for it. There's a difference between celebration and hubris. Quite a difference. Avoid hubris at all cost. Temperateness means actively avoiding being cocky. Understanding a lucky streak is a lucky streak and not a permanent state of genius. It's exactly because good decisions and good outcomes aren't perfectly correlated the adage, everyone's a genius in a bull market, exists. For many, one aim of investing is to become financially independent, living off of the capital or at least passive income. One interpretation of that scenario is allowing oneself to relax, to slack off, and enjoy life, often meaning not working hard on the stock market. Half-assedness and mediocrity. Since that's the end game, relaxing a little on the way there, in particular after a few wins, can seem warranted and well-deserved. And why not? You obviously have a strong game, right? Wrong. The world's fastest man needs to run at a 100% of capacity to win his races. And he still won't be certain to win all of them, just 1% slower, i.e., at 99% of capacity, he'll be 0.1 of a second slower over the race and could easily miss the silver and the bronze as well. Only expect good results if you work for them. Even a good investor has as many losing trades as winning ones. Hence, the margin of safety is typically quite thin. Consequently, there is no significant room for complacency based on self-aggrandizement. By all means, take a pause to celebrate and reflect, but make it a real pause with zero investments, not a period of half-assedness and mediocrity. Hubris and complacency are any investor's ultimate weaknesses. Unbiasedness. Unbiasedness, making sure nuanced facts rule opinions and wishes. Shopping when you're hungry is a bad idea. In investing, there are two major groups of enemies. Other people, really, really tough, competent and competitive. Yourself, much, much worse. Unbiasedness means focusing on the actual data and established causal relationships, while actively avoiding other people's power of persuasion and mitigating adverse effects and cognitive blindness due to psychological biases. Focus on facts, not opinions. With unbiasedness, I mean not caring about how and why you came into a holding, only what its future return and risk characteristics are. With unbiasedness, I mean not letting your investment process be unduly affected by history, by friendships, by salient sales pitches, by half-truths, by wishful thinking, by groupthink and reluctance to speak up. With unbiasedness, I mean freedom from external pressures and irrelevant information on the one hand, and systems for managing your own cognitive biases, such as herding, social proof, availability, anchoring, confirmation, hindsight bias, etc. on the other. Unbiasedness, the holy grail of investing. I admit I often indicate traits as being of paramount importance or indispensable. Unbiasedness is no exception. If your investment process is biased rather than solidly anchored in reality, your decisions will inevitably be all the worse for it. Unless mitigated by a disproportionate amount of luck, your investment returns will consequently be significantly lower and possibly negative. If you let yourself be swayed by charismatic snake oil salesmen, online stock forum pundits and friends, brokers, or incumbent owners, you're more likely than not to be positively biased and paying too much for your investments. Sure, You can find yourself on the right side of chance and get to ride an unexpected boom. But you can also end up buying IT companies at the peak of the 1999 to 2000 technology bubble. Or mortgage brokers, house builders, and banks in 2007. Writing these words on June 26th, 2018, I think Tesla, TSLA, 333 USD per share, is a great case in point, with snake oil salesmen peddling its cars, batteries, and electrical energy products as the best thing since the internet. I hope you tread very carefully. Personally, I think its shares are completely worthless. Buy or bye-bye. Similarly, to more or less skilled peddlers of dubious advice, your own biases can play tricks on you. Since you want to be rich, since you want stocks to rise, since you only have limited research resources, you hope whatever stocks you have time to investigate will rise, you invest in the first companies you come across in a stock screen or broker's recommended list, and then adjust your models until the stock is a strong buy. You keep adjusting if the price surpasses your initial target, just like any professional sell-side analyst would. If it's not a buy recommendation, it's a buy-buy for you as an analyst, i.e., you won't be welcome at neither the company's nor your long-only client's premises. Carefully collect all facts and arguments, positive and negative with the same intensity. Unbiasedness is the holy grail of investing, since it's so difficult to attain and maintain. Your mind keeps blinding you, fooling you with plausible narratives, telling you to conserve energy, preserving your homeostasis, by disregarding negative information, encouraging you to pursue the path of least resistance, of following the herd, of simply confirming what you already think, of hiding news to the contrary from your attention. A certain kind of investors may find their homeostasis making them always contrarian, which is at least as bad as always conforming. Make decisions and take action with freedom of mind. Form your investment opinion with a minimum of external influences, but actively seek out opposite views. Unless you have the right infrastructure of checklists, people, best practices, etc. in place, you won't even suspect you're biased. That's part of the very definition of bias, even if you do pay lip service to unbiasedness by superficially entertaining the opposite side. You're most likely to just pat yourself on the back with a congratulatory, "I checked." Hence, nobody can call me biased. Stand up to yourself and your ideas, as long as the data support them, but not longer. Unbiasedness means focusing on facts, for and against irrespective of their source, actively countering any psychological biases, using checklists and best practices to counter greed and wishful thinking. Unbiasedness means shunning groupthink, decision by committee, and dangerous exposure to biased people with hidden agendas. Unbiasedness means independence, even from your own preconceived notions.
Be truly independent.
Neither a crowd follower nor a die-hard contrarian. Resoluteness. Resoluteness. How to foster the rational conviction to swim undeterred against the stream. The resolve of vampires and werewolves. There is an ongoing battle since time immemorial between two seemingly immortal clans of mythic creatures. One sucks its sustenance daily, while the other comes out once in a blue moon to feast on the weak. I'm referring to, respectively, buy and hold investors on the one hand and value investors on the other. The former indiscriminately keeps sucking away at cheap and expensive markets alike, whereas the latter wait for the lure of the full moon before making the effort to pounce on weak and abandoned companies trading below fair value. Superstition aside, both investment models have nice track records. They have performed more or less equally well over the last 100 years. The thing, however, is that even if they are comparable over longer time periods, their performance can differ significantly over half cycles of around 5 to 10 years. an investor lacking the right conviction and resolve could be forgiven for switching from a value investing based strategy to buy and hold after a long bull market, such as today, June 25th, 2018. He'd be in good company. Well, in numerous company at least. The curse of always being too early. Value investors often buy too early on the way down and sell too early on the way up. Value investors thus miss out on the last explosive phase of a bull market, in particular if it's an outright investment mania or bubble. Thanks to avoiding large parts of downturns, however, a well-calibrated Vail investor system still captures a similar return over time as a buy and hold EER, albeit with significantly less volatility and drawdowns, in theory opening up for more leverage. To get the full benefit of either the value investor or buy and hold style, the investor needs to stick to the chosen model, in particular after a period of weak returns. In fact, theoretically, the worst time to switch is when your model has performed relatively poorly over several years. The reason is this: if both models are to keep producing the same long-term returns, periods of underperformance will be followed by periods of overperformance.
At the peak of a bull market, valuations are too high for value investors, whereas batchers couldn't care less. They think everything is going swimmingly and that they are finally hitting their stride. Come join us, they sing. But right when switching from the poorly performing sixth model to the obviously better performing BAH model is the most appetizing, that's when the timing is worst, and your resolve is the only thing standing between you and a market timing disaster.
Buy and hold, on the other hand, could get undeservedly lucky if they unexpectedly decide to abandon their gravy train right at its fattest supply for the apparently decrepit value investing system. Further, adherents of buy and hold shouldn't switch halfway through a bull market, persuaded by the Cassandra cries of werewolf, right when the bull market party is about to hit its stride in earnest. Slightly expensive stock markets can easily double during the second half of a bullish half cycle, something value investors often forget. Resoluteness, choosing a method and sticking to it. There are, of course, many other ways of investing. The point I'm trying to make is simply that, after some length of lean times, it takes a certain kind of inner strength and tenacity even to stick to a system you know works. Refreshing and making use of some of my earlier TAOS investment principles helps in reinforcing that resolve. Fear and greed should only happen to other people. Stick-to-itiveness demands rational conviction. If you don't know how your system works, if you don't know why you're using a certain method, if you don't base your strategy on a logical and rational, solid foundation, any conviction you started out with is both unwarranted and likely to be subject to erosion under pressure. Trade only as scheduled. The reason model-based hedge funds don't second-guess their models during losing streaks is they trust whatever work they put in to create those models. Their conviction and resolve is rational, and they know it. That kind of robustness is a prerequisite for lasting psychological strength in the face of financial and verbal insults. Trust your well-defined and back-tested method, enough to base your decisions on sound reasoning and cold calculation in pressing times without second-guessing. Resoluteness means staying the course when the times get tough, when your funds are shrinking and you're being ridiculed by fair-weather traders. Resoluteness means swimming undeterred against the stream, secure in the conviction you have a strong strategy that works over time, the right risk management and patience to wait out temporary setbacks. In short, you have an independent system that insulates from biases, herding, and sudden whims, and thus have the rationally based psychological strength required for successful investing. A good strategy is like a cage for your reptile brain. Adequateness. Adequateness. Being pragmatic analytical, guided by empirical evidence. There is no such thing as supernatural beings. That is an indisputable fact, since everything in nature is natural, and given nature is defined as everything. South. I'm sorry to break it to you, there are no were-evolves, unless werewolves are natural, of course, which they might be. It's just that the probability of humans living on Earth in the 21st century ever coming across a true shifting werewolf is so close to zero, there really are no reasons to take the possibility into account. However, should one happen to fall into your lap, it might be time for a rethink. Facts, 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 facts. No, that's not the opening scene in 4 Weddings and a Funeral. That's the gist of adequateness. Reality is what it is. A is A, and so on. Be curious in investigating reality. Just don't get ridiculous regarding probability weights. Be open to exactly what reality entails, what the empirical evidence actually tells you, and how you can make practical use of it. The probability of the existence of God, a tea kettle orbiting the sun, or a spaghetti monster, or intelligent design for that matter, is for all practical purposes 0, at least down to the 100th decimal place, whereas, e.g., the principles of evolution and the natural law of quantum mechanics have been confirmed in a multitude of clever experiments and never refuted. There is nothing 50-50 or you have your view and I mine about it. It's all good and well having a great strategy, being patient enough to wait for the right moment, learning from mistakes, never going all in, being thorough and calm, exploring unexpected vantage points, avoiding hubris and biases, not to mention being rationally resolute. However, if you fall prey to superstition or start assuming instead of investigating, all your hard work could be for naught. It's the facts that count. It doesn't matter how great your model is if your input is garbage. You need all your zeal and agility to collect the facts and all the other psychological facets of chaos to implement the facts and execute the investment. But first of all, you need the facts. Shit in. Strategy, patience, resilience, endurance, zeal, zen, agility, temperateness, unbiasedness, resoluteness. Shit out. What facts? I am not a rigid financials and economics professor type, claiming only cash flow and interest rates count as facts. Perhaps a bit surprising, I'm quite open to any kind of empirical evidence of relevant causal correlations in repeatable research, be it HFT trading algorithms mined by machine or deep learning systems, or more down to earth, value-based methods using publicly available financial reports. I don't care what kind of facts you use, as long as they are facts, and you are open to those facts being wrong, misinterpreted, and evolving. Oil facts? Maybe the Cushing oil inventory level at one point was a relevant variable for the price of oil. Maybe OPEC production quotas and their publications once was important information. Maybe open speculative interest was. But maybe they aren't today or won't be at some point in the future. Maybe new flexible storage capacity, new exploration technology, new pipelines or zero funding costs are changing the facts.
Maybe even the very underlying fundamentals of production, demand, storage, transportation, energy substitutes, and human speculation aren't that important for a prolonged period of time due to tens of trillions of dollars having been conjured from nothing over the last decade. Perhaps algorithms have already thrown everything out of whack and are running circles around us mere humans laughing at our feeble attempts to participate in the game.
Perhaps, perhaps not. Investigate and analyze the actual evidence. Don't assume. Stop, collaborate, and listen. Whether the AI scenario above is relevant or not isn't the issue. My message is that it's up to you to research the relevant data for your investment style in order to find facts that hold water, rather than assuming heavy objects fall faster than light ones. If you want to pour a metric ton of liquid steel, you'd want to check the metallurgical facts thoroughly first. Treat large investments the same way. Research what needs to be researched for your style, sizing, and risk level. Sometimes the truth hurts, but better sooner than later. Better the ego than the wallet. Or, in the above case, better stand corrected before than a statue after. Due to an as unintended as scorching shower. So if things don't evolve as expected, take stock of the evidence. Listen to your adversaries and cooperate if possible to establish the truth. Then you can apply whatever different models and methods you prefer to massage those facts into investment decisions. Reality is what it is. Be curious and pragmatic. Your ego, your assumptions, your self-image, your status are all irrelevant to your investment prowess. The only thing that counts is the facts of your entry point and your exit point. To get those things right, you have to stand back to reality, be interested in and love reality. It's there, no matter if you want to or not. Don't be stubborn.
Look for and allow new empirical data
to change your investment thesis.
Adequateness means establishing facts and truths, ruthlessly discarding obsolete heuristics, misconceptions and prejudices.
Adequateness means conforming to reality, analyzing what is actually there, rather than what you'd like it to be. You can't close your eyes to reality? Well, you can, but that won't stop the train, lion, or stock market. Be analytical while you still can. If you actively pursue and accept the facts, you can analyze them rationally and take actions accordingly. But if you stay in the denial phase for too long, panic will sooner or later hamper your ability to do anything about the fact of the hammer hitting you on the head. Hope is not an adequate strategy. Ignoring the facts won't mitigate the extent of your eventual losses.
Self-analysis. Self-analysis creates an invaluable, exponential feedback loop of improvement for all Tao's components.
Supercharging the engine. Okay, I admit I know next to nothing about gas engines, but I think there is a way to increase the efficiency and effect by feeding some of the exhaust fumes back into the carburetor, or something like that. I've had both a Lamborghini and a Ferrari, but never a turbo engine, so I can't say for sure.
A positive feedback loop works in a similar way, with your insights and adjustments from introspection continuously fine-tuning your investment methods.
In practice, self-analysis means you should prepare, track, and study various facets of your investment process and performance. Why did you gain or lose money in a certain investment? Was it due to luck or skill? Was it for the reasons you entered the position or something else?
Did you adhere to the other 11 Tao's guidelines?
Did you follow your strategy? Was the strategy well-founded? Did the position have a good fit with your strategy? Did you write down the reasons for investing before making it? Did you wait patiently for the right entry and exit points?
Did you size your position responsibly?
Did you go the extra mile, doing the mathematics yourself rather than trusting an authority?
Did you keep your calm and rationality?
Did you explore other sides of the story? Or did you fall prey to availability bias and selective perception? Did you become cocky, thinking, I've got this? Did you follow your best practices and other procedures to discover and neutralize dangerous and biased tendencies? Did you stick firmly to your own conclusions? Or were you swayed by clever salesmen or the cozy feeling of belonging to the herd? For every Tao's trait, an intellectually honest analysis can reveal mistakes and weaknesses, as well as strengths and strokes of genius. Thus, you should feed back whatever you learn from both your winners and losers about the way you handle the other 11 Tao's traits of a great investor. Maintaining a habit of post-game analysis and introspection can refine and enhance both psychological, technical, and mental aspects of your method, cutting out unwanted aspects, creating boosters and breaks, checks and balances that make you perform more consistently on the financial markets. You are nothing but a naked ape. Author Desmond Morris studied humans from his perspective of a zoologist, as if humans were just one more primate. You should try to replicate Morris's work with you as the test subject. Make an impartial FBI serial killer profile on yourself, as you would any other portfolio manager you were thinking of employing. Look at your actual behavior and choice of investment and trades, not your ideal or target M&O. What would somebody else conclude? Your style is given statistics on your buying and selling. Would they, e.g., say that you are long-term or short-term, emotional or systematic, fundamental, value-based, or chart-driven? Compare your behavior with what you think would be an optimal strategy for you. What has been the difference between your game plan or desired course and your actual actions? There are at least two aspects to this exercise. One is identifying your de facto strategy. The other is mapping your psychological profile to see if it can be tweaked over time to gradually modify some of your traits into something more effective. Scrutinize your modus operandi. Analyze wins as thoroughly as losses. Every diligent investor picks apart his losing trades to see what went wrong. But I urge you to not forget about the winners, camouflaged losers. Sometimes your wins were well-deserved, logical outcomes of a robust and effective investment process, but sometimes you just got lucky. The latter, a camouflaged loser, is an investor's worst enemy, as it can ingrain bad habits. Sometimes you do make a lot of mistakes, are impatient, reckless, and emotional, but achieve gains for other unexpected reasons. Unless the reasons for investing, which should have been written down before taking the trade, have a clear and logical association with the ultimate result, it was a bad trade. The key to long-term strong investment performance is repeatability, and you can't reliably replicate luck. Inspect your successes and failures thoroughly, your weakest link. All humans are hampered by biases, by homeostasis, by laziness, by emotions like greed and fear. Strive to identify your worst weaknesses and biases, e.g. by asking your friends and by analyzing your trading diary and other notes of your behavior and decision process and outcomes. Once you know where your own particularly destructive psychological landmines are hidden, you can employ tactical countermeasures beforehand. Counter your drawbacks and make the best use of your strengths with clever routines and habits based on your commonplace notes and self-analysis. I have found checklists and lists of best practices that preempt unnecessary mistakes to be especially useful. For example, keep a post-it with the words "never rush," "never trade" when emotional, "get up and walk" while counting to 10 before ever making an investment. A fundamental investor might want a checklist with entries like short interest, largest shareholders, index inclusion or exclusion imminent, earnings report dates, product launches, product cycles, and does the investment conform to my strategy? Can I trust its accounting policies? Does it fit with current trends for USD, oil, interest rates, gold, commodities, etc.? Write down what needs to change or not change for the investment to work out as planned. What do the sellers say? Identify your irrational tendencies, biases, inclinations, and flaws. Without preconception. Preempt your own reflexes and emotions. Control them with bespoke tactics and strategies. Self-analysis means integrating the realization that your investments are prone to as much human error as everybody else's. It's never enough to just gather numbers, stats, tables, and graphs. You have to actively fight against and try to neutralize your blind spots, your cognitive biases. Sure, knowing Apple's strategy, numbers, and image is a good start. But if you don't keep your own human irrational tendencies under close guard, or forget to constantly improve and evolve your method and execution of it, you'll find yourself on the losing side sooner or later. Ownership bias, e.g., makes you want to keep what you have at a higher price than you would have paid to get it in the first place. Availability and proximity biases make you consider and overweight whatever is close at hand. Homeostasis and laziness stop you from looking for errors in your investment thesis. Selective perception bias makes you only hear whatever supports your case, and so on and on. Are you overly emotional? Put procedures in place that force you to be calm before making a trade. Do you have FOMO tendencies? Make sure your checklist requires a certain kind of conservative value calculation before hitting the buy button. Are you often unnecessarily cautious? Find a way to pump yourself up and get the adrenaline flowing before deciding on the amount to put to use. So, know yourself, keep track of yourself, analyze yourself, implement breaks for your worst psychological biases. Allow yourself to consistently improve by feeding back lessons about yourself, fully owning both your strengths and your weaknesses. Investing is about forming a strategy and following it. It's about measuring and analyzing assets and their environment just as closely as yourself. You need to understand both how the world and you work in order to consistently make sound investments, and not let fear, greed, or biased data collection lead you astray. Your investments are made in the interface between you and the world. You need to know both to get it right.
Summary and conclusion. Becoming a great investor.
These are my 12 investor guidelines and desirable traits, the condensed lessons from focusing on the stock market for 15 years at the best hedge fund in Europe. Owing to the elevated position of Futuris, I have had the opportunity to learn from the very best right while we were making magic. Our team was great, but we still made many mistakes. Perhaps I stumbled more than most, but we were all good at picking ourselves and each other up and learning from our mistakes. Overall, we produced amazing results and won several prestigious awards, including the one for Best European Hedge Fund over a decade, 2000 to 2009. The 12 traits together spell Sprezzaturas, as in Sprezza's guidelines. Strategy, patience, resilience, endurance, zeal, zen, agility, temperateness, unbiasedness, resoluteness, adequateness, self-analysis. What does Sprezza stand for? Sprezzatura is the art of studied nonchalance, of making impressive and hard-won skills look inborn. The 12 traits of Sprezzatura investing can be loosely grouped into 4 investment imperatives. Have a plan, do the mathematics, wait, be unemotional. Taking these lessons to heart and adapting them to your personality, you too can, given enough time and effort, make investing look deceptively easy. Pause. Thank you for reading. Pause. The Art of Sprezzatura. Pause. Remember the 4 overarching guidelines. Plan, analyze, wait, unemotional. Karl-Mikael worked at Futuris as managing director, analyst, portfolio manager, and partner, the years 2000 to 2015. Among many other awards, Mr. Seeding received, on behalf of Futuris, the HFR Award, the European Hedge Fund of the Decade, 2000 to 2009, in competition with thousands of European hedge funds.